Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the Yotta Scale transformation of AMD. Now, when we say Yotta, we're talking about 10 to the power of 24. It's a scale of computation, of infrastructure, that is. It's almost impossible for the human mind to really grasp,
Right.
but it's precisely the scale that frontier AI is demanding right now. So this deep dive, it's about a lot more than just silicon. We're examining a fundamental, really a disruptive shift in their entire business model.
And that Yotta scale concept is so crucial because it just sets the stage perfectly. I mean, if you look at the market right now, the pace of AI innovation is, it's truly an order of magnitude faster than anything we've ever seen. And it's all driven by this simply insatiable demand for AI compute.
Everyone is scrambling.
Everyone.
Yeah.
From the biggest hyperscalers like Google and Meta, all the way down to sovereign nation states, they're all engaged in these unprecedented massive infrastructure build-outs. And when you're operating at that scale, the constraints aren't just chip performance anymore. It becomes about power, cooling, connectivity, and fundamentally it's about the system architecture.
That's why the traditional model of being a component designer, just selling a chip, it just doesn't work anymore. The whole build-out dictates a new role. And our core thesis today is that AMD is making that transition. They're moving from being a high-performance component designer into a full-blown data center scale systems architect. They are positioning themselves, and very deliberately, as the primary viable open ecosystem alternative to the current market leader.
And if we really, boil down the core investment opportunity, you can see three interwoven pillars that support this really audacious shift.
Okay.
First, they are aggressively accelerating their product cadence. They're moving their flagship Instinct GPUs from what was, a traditional 2-year cycle.
To an annual one, a hyper-competitive annual cadence.
Exactly, an annual cadence. That's an imperative now. You have to do that to stay relevant in the AI market.
Okay, so that's pillar one, speed.
Pillar two is the architectural shift.
This is moving past just selling individual GPUs in a box.
Right. It's moving toward full rack-scale solutions. They're selling integrated AI factories, and this is all embodied by their new Helios platform.
They get that the customer needs a whole system that just works on day one, not a pile of parts they have to figure out themselves.
And the third pillar, this is the one that provides the critical validation, the proof that this whole systems approach is even viable.
This must be the OpenAI deal.
That's it. The definitive, multi-generational 6-gigawatt partnership with OpenAI. This deal validates AMD's hardware, but even more importantly, it validates their open software stack, ROCm, for the world's most demanding models.
This is where the rubber meets the road.
Absolutely.
Okay, so let's unpack this transformation because it sounds like a massive bet on coordination. The strategic shift away from just selling individual chips to delivering these AI factories, that feels like the biggest change in AMD's history since they created EPYC. Why now, though? Why can't hyperscaler just buy the best chip and figure out the rest themselves?
Well, it really comes down to physics and integration complexity at that Yotta scale we talked about. When you're deploying tens of thousands of accelerators, the bottlenecks, they stop being the individual chip's peak performance.
And they become other things.
They become things like power efficiency, inter-chip communication, latency, heat management. So delivering an AI factory means AMD takes responsibility for the whole system design. We're talking CPUs, GPUs, the networking, thermal management, and that crucial cluster-level software design.
And management has been explicit about this.
They have. They've said this is now their single most important strategic priority. They realized that just having the most powerful chip isn't a winning strategy if that chip can't talk efficiently to the other 1,000 chips in the cluster.
And that system-level design, that's what culminates in their flagship architecture, the Helios rack-scale solution. This platform is scheduled for a huge launch in the second half of 2026, which is perfectly timed with the big deployments we're going to get to.
Helios is a staggering technical achievement. It really represents the convergence of all their investments in integrated design and advanced packaging. Just think back to their very first successful EPYC chiplet implementation years ago.
Right.
And now compare that to Helios. This platform shows a 30x increase in the total available silicon for compute and memory relative to that first-generation EPYC.
30 times.
That kind of scale just dramatically improves the TCO proposition, the total cost of ownership for the customer.
And what exactly are they integrating into this AI factory? It's not just the new GPUs, is it?
No, not at all. It's a holistic integration of their entire silicon portfolio. So you have the high-performance MI455 GPUs, which are the specialized heavy
The
lifters.
accelerators.
Exactly. But you need a brain to manage the whole operation, so it also integrates the next generation of their server CPUs, the Venice CPUs, which are based on the Zen 6 architecture.
Okay, so you have the muscle and the brain.
And critically, you have the nervous system. It includes the networking and smart offload elements using Pensando networking and DPUs.
Data processing units.
Right. And without that Pensando technology, the data pipes would just immediately bottleneck the accelerators. The whole thing would grind to a halt.
I want to dig in on the underlying tech here for a second, because this is where that deep chip design expertise meets the new systems architecture challenge. You mentioned packaging interconnect density.
Yes. For the MI400 series going into Helios, they're using advanced packaging to get a doubling of packaging interconnect density compared to the last generation.
So what does that mean in, practical terms?
It means the specialized high-bandwidth communication links between the different chiplets, the memory, the compute cores, the I/O, they're twice as efficient and dense. That minimizes the latency for crucial operations, like shuffling data to and from that high-bandwidth memory, the HBM.
So without that packaging, the whole chiplet design wouldn't work at this scale.
It would fail. The communication overhead would kill it. These packaging breakthroughs are what make their cost-effective chiplet architecture viable at Yotta Scale.
And of course, at this density, heat is the ultimate enemy of computation.
Absolutely. The system is designed from the ground up to be liquid-cooled. Air cooling is it's obsolete at these power densities.
And they're working with partners on this, right? It's not some proprietary black box.
That's a key point. By adopting open standards for cooling and connectivity and co-developing this architecture with partners like Meta, who are huge proponents of open standards, AMD ensures that Helios is a scalable, interoperable solution that fits into existing diverse data centers.
Now, this brings us to something that I found really surprising at first, the acquisition of ZT Systems. Buying a systems integrator, it sounds like they're suddenly getting into the heavy manufacturing business, which just runs counter to their whole capital-light, high-margin model. Did they just buy a factory?
That is the perfect question, and the answer to it really reveals the strategic genius of the move. They acquired the ZT design team, specifically 1,000 top-tier systems engineers and all the intellectual property needed to design these complex rack-scale solutions.
So they bought the brains?
They bought the brains. This expertise was non-negotiable for them to accelerate the time to market for MI450 and Helios. They needed the people who knew how to design a liquid-cooled rack from top to bottom, optimizing every single aspect of power, cabling, and thermal exchange.
But the really crucial detail is what happened immediately after the acquisition.
Precisely. They divested the ZT manufacturing operation.
So they didn't want the factory.
They didn't want the factory, they didn't want the low margins, and they didn't want the heavy capital expenditure that comes with assembling and selling the physical racks. AMD is staying committed to that high-margin, capital-light approach. They design the reference architecture, the blueprint for the AI factory, and then they sell the high-margin ingredients.
The CPUs, the GPUs, the DPUs.
Right, and they rely on their strong OEM and ODM partners to handle the actual assembly, shipping, and deployment.
So they get the essential intellectual capital, the design brain, without taking on the physical risk or the lower margins of the manufacturing muscle.
And that structure directly reinforces their central value proposition in this space.
The open ecosystem approach.
That's the entire point. By staying capital light and divesting manufacturing, they're signaling to their partners, the OEMs and ODMs, that they are not competing with them. They're an enabler. And by leaning so heavily into open standards, open source software like ROCm, and open hardware standards like Ultra Ethernet and Ultra Accelerator Link, they are offering customers choice.
Choice is everything for these hyperscalers.
It is. This gives customers a viable path where they can mix and match components, avoiding the vendor lock-in that defines their main competition. And that freedom, that translates directly into a lower long-term total cost of ownership for these big customers who are just desperate for optimization.
Strategic design is one thing, but execution needs validation, especially when you're challenging a deeply entrenched incumbent. And that validation comes directly from that massive 6-gigawatt agreement with OpenAI. Let's just pause and really contextualize that number. 6 gigawatts over 4 to 5 years. That is an immense power commitment.
The scale is foundational. I mean, to put 6 gigawatts into perspective, that's roughly the capacity of 6 large nuclear power plants.
Or enough to power a few million homes.
Exactly. It signifies that OpenAI, the entity that is at the absolute frontier of AI development, is betting a huge chunk of their future infrastructure growth on AMD's hardware, and critically, on the ROCm software ecosystem. This isn't some small trial run.
No, this is a foundational, multi-generational partnership.
It is.
And the first gigawatt of this huge deployment is expected to start ramping up in the second half of 2026, which is right alongside that MI450 launch we just discussed. It's a direct, measurable demand signal.
A demand signal few companies in the world can match. And while the OpenAI deal is the linchpin, you have to remember, management confirmed they are actively pursuing multiple additional multi-gigawatt engagements with other hyperscalers and AI-native companies.
So once that door is open at that level,
Once the market sees that OpenAI deems the AMD stack capable of running their most cutting-edge models, it just opens the aperture for all those other high-scale discussions significantly.
what's really fascinating here isn't just the size of the deal, but how they structured it financially. This wasn't a standard purchase order. They used a unique warrant structure.
This is such a critical detail because it changes the whole dynamic from a vendor-customer relationship to a true partnership.
Yeah.
AMD used warrants, which are financial instruments giving the right, but not the obligation, to purchase equity at a set price to align OpenAI's financial incentives directly with AMD's success.
So if AMD executes flawlessly and their stock price goes up as a result, OpenAI benefits financially by exercising those warrants.
Exactly. It ensures OpenAI is actively and financially motivated for AMD to be successful. It's not just about getting the hardware delivered, it's about working diligently on the deployment, ensuring the software stack is optimized, and hitting all the performance milestones. The financial upside for OpenAI is performance-based.
So it creates a deep, long-term alignment.
A true partnership.
Now, when this deal was announced, the stock popped, nearly 30%. But naturally, there was some investor skepticism. What was the core risk factor people pointed to with this warrant structure?
Yeah, the main concern raised by critical analysts was the potential for equity dilution. The structure means AMD is giving up equity up to 10% over the course of the deal, tied to the size of the deployment.
Right.
And the worry wasn't necessarily the partnership itself, but the possibility that OpenAI, after vesting, might just dump tens of millions of shares on the market to produce immediate earnings for themselves.
Which would hurt existing AMD shareholders.
Exactly. It raised valid questions about the true long-term benefit for shareholders versus the short-term pop from the validation headline. Now, AMD's counter has always been that this is a long-term, highly structured deal designed for mutual success, not a quick cash out.
Okay, let's pivot from the financial engineering to the technical co-design that made this all possible. AMD developed the MI450 series specifically with OpenAI's use cases in mind.
That co-design was intense. They focused particularly on optimizing performance for inference. While training these huge models gets all the headlines, inference, actually using the model in production, that's where the real volume and the ultimate profitability lie.
And the MI450 was tailored for that.
Tailored for those high-volume, low-latency and inference use cases.
But the critical technical angle here is the software, specifically AMD's active work to support Triton. We hear constantly about the CUDA moat protecting the incumbent. Explain how Triton specifically undermines that advantage.
This is the crux of the competitive strategy. The CUDA moat refers to the decades developers have spent writing low-level, highly optimized code for the incumbent's proprietary hardware using the CUDA programming language.
It's a huge barrier to entry.
A massive one. But Triton is a framework that was developed by OpenAI. It's designed for parallel processing, and it acts as a high-level intermediary language.
So instead of writing millions of lines of proprietary code, developers can just write in Triton, and Triton handles the translation to the underlying hardware.
That's it. Triton is designed to be hardware agnostic. So by working so deeply with OpenAI to make sure the Triton backend perfectly supports AMD's MI450 hardware, AMD effectively bypasses the need to have that massive, decade-deep ecosystem of proprietary CUDA code.
Developers can port their work more easily.
Much more easily. The moment model developers, the true innovators like OpenAI, adopt a hardware-agnostic language, they are actively freeing themselves and the rest of the industry from being locked into a single proprietary platform. And that work doesn't just benefit OpenAI, it absolutely accrues to the rest of the AMD ecosystem. It significantly lowers the barrier to entry for every other company considering ROCm.
It's a precision strike at the incumbent's primary defense.
It really is.
As we move from the accelerators to the rest of the AI factory, we have to tackle that persistent fear that has haunted the by 86 world. The GPU cannibalization fear. The narrative was simple. As GPUs get faster and faster, general-purpose CPUs become marginalized.
Yeah, and AMD's data from their biggest customers suggests that thesis is just entirely wrong. In fact, they've consistently observed the opposite. CPU demand is accelerating directly in proportion to how much AI is being deployed.
The opposite is happening.
The opposite. For every dollar spent on AI accelerators, they're seeing a renewed, accelerating demand for general-purpose CPUs to manage all that acceleration.
So if the GPUs are handling the heavy lifting of training, what new demands are these massive AI build-outs placing on the CPU? It sounds like we're moving beyond just simple server refresh cycles.
We're seeing a fundamental change in the type of AI that's being deployed in production. And the primary drivers for this CPU acceleration are these complex, multi-step AI systems, specifically agentic AI and retrieval-augmented generation, or RAG.
Okay, let's define agentic AI for our listener. This is the vision of truly autonomous systems, right? The digital workers.
Correct. Agentic AI refers to these sophisticated systems that can break down a complex goal into multiple smaller steps, execute those steps, make decisions, and self-correct, all without human intervention. One executive described it as deploying 1,000 agents or 1,000 virtual employees at the same time.
And when you have thousands of these virtual employees running around, they need a central manager.
That's exactly where the CPU comes in. If the GPU is the specialized surgeon executing a singular, high-precision task.
The CPU is the chief of staff running the entire hospital.
Perfect analogy. These agents need general-purpose CPUs to run their orchestration, synchronization, memory management, all of those control tasks. It generates entirely new compute needs that GPUs are just not designed to handle efficiently. The CPU is the glue that makes the whole GPU cluster productive.
And the other big driver is RAG, which is critical for making sure AI models are accurate and up-to-date.
Absolutely. Retrieval-augmented generation, or RAG, is the technique that ensures these large language models don't just hallucinate or rely only on their initial training data. RAG requires the system to go out and retrieve facts from massive, constantly changing external databases, process that data, and load it into the model's context in real time.
And that's all CPU work.
Almost all of it. All that pre- and post-processing, the huge ETL operations, storage workloads, database analytics, that all runs predominantly on standard by 86 CPUs. The expansion of the AI pipeline mandates a powerful CPU infrastructure.
And beyond the complexity, there's also just an efficiency element, right? Offloading some work entirely from the scarce, expensive GPU.
That leads to the rise of CPU inference. The explosion of smaller, domain-specific models means that many real-time inference tasks can be run extremely cost-effectively on the CPU itself. When you have high core counts available, which is the hallmark of AMD's EPYC platform, you can use those extra cores for certain inference tasks without needing to dedicate a $30,000 GPU to something simple.
It's a pure TCO play.
Pure TCO.
So with this accelerating demand, what's AMD's ambition for its server CPU market share? They're already over 40% revenue share, which is just a remarkable achievement considering they started at basically 0 7 years ago.
That 40% is explicitly viewed as just an intermediate milestone. AMD sees a clear, durable path to achieving over 50% revenue share in the server CPU market over the next 3 to 5 years.
Over 50%.
And that ambition is tied directly to the strength of their roadmap, including the next-gen Zen 6 Venice processors, which continue to deliver these generational leaps in performance per watt.
You know, this sounds uncannily familiar. You mentioned their historical playbook earlier. This entire CPU strategy delivering superior core density, better TCO, a consistent roadmap, that's the same playbook they're now applying to the GPU market, isn't it?
It is the exact playbook. We call it the EPYC playbook. They established their dominance starting with the Rome and Milan generations by delivering real technology differentiation, maintaining a competitive multi-generational roadmap, and crucially, just diligently building customer trust through flawless execution.
They proved they could be a reliable second source.
And now they're applying that proven model to the GPU space with the MI400 series. The core takeaway for any investor is, they are not just hoping for success here, they are leveraging a proven methodology for market disruption.
So if the tech roadmap and partnerships are successful, what does this all translate into financially? AMD has laid out incredibly aggressive long-term financial targets for the next 3 to 5 years. And I have to admit, reading these numbers, they sound almost aspirational, almost like a Silicon Valley fairy tale.
They are definitely high-stakes projections. They embed immense expectations for flawless execution. Starting from a 2025 baseline revenue of about $34 billion, the management team is projecting a total company revenue CAGR of greater than 35%.
That is a massive growth rate for a company of this size.
It is. And within that, the data center business CAGR is targeted at over 6%, with the critical data center AI revenue CAGR expected to be over 80%.
So AI revenue is really driving the majority of their growth in the coming years.
Absolutely. They are targeting tens of billions of dollars in data center AI revenue in 2027. And that level of scale is what underpins the whole financial model, culminating in an overall earnings per share, or EPS, target of greater than $20 over that 3 to 5 year forecast period.
Greater than $20 EPS, coupled with an operating margin target of over 35%. To hit that, everything has to align perfectly.
It does.
That's the friction point I want to introduce. Hitting a $20 EPS goal requires not just great tech, but conquering the competitive landscape. What are the 2 or 3 things that have to go absolutely right simultaneously for them to achieve that kind of growth?
That's the critical question for any investor. First, the MI450 launch in 2026 has to be flawless. Any slip in availability or performance gives the incumbent more time to execute their own annual cycle.
Okay, so execution on the hardware.
Second, the OpenAI partnership has to translate directly into sustained revenue. The 6-gigawatt deal can't be a one-off. It must serve as the global reference design that pulls in Meta, Microsoft, and others who are desperate for an alternative. And third, they have to keep leveraging that capital-light ZT model to keep R&D costs relatively constrained while still delivering that system-level performance.
Speaking of costs, let's talk about the margin strategy they're using right now, which involves a temporary strategic acceptance of lower GPU margins. That seems counterintuitive when the stock is already priced for perfection.
It's a tactical decision, and it's driven purely by market dynamics. Management has confirmed that the current GPU gross margin is slightly below corporate average, which they usually target around 55% to 58%.
And the rationale.
Simple.
Yeah.
They're in a hyper-growth land grab. The priority right now is maximizing gross margin dollars and capturing dominant market share, not optimizing the percentage itself.
Why does maximizing the dollar volume matter more than the percentage right now?
Because the incumbent has such a deep proprietary software moat with CUDA. For a large hyperscaler to switch platforms, which involves retraining engineers, rewriting software, reconfiguring infrastructure, they need a significant, measurable total cost of ownership benefit.
So AMD has to make it economically appealing to switch.
They have to, even if it means sacrificing a few percentage points of gross margin at first. Securing a massive multi-gigawatt deal at 50% margin generates far more revenue and long-term stickiness than holding out for 58% on a deal that never happens.
And the long-term expectation is that margins will improve over time.
Exactly. As volume scales, design gets optimized, and future generations add more value, they expect gross margins to steadily improve over time.
It's also vital to remember that the confidence in hitting this massive $20 EPS target isn't just riding on the data center division. Their projections are built on broad market share gains across all their segments.
That diversification is the stability factor. The growth requires success across the board. We talked about the server CPU path to over 50% revenue share.
Right.
On the client or PC side, they're aiming for over 40% revenue share, up from the high 20s today. They're betting aggressively on the AI PC wave with their Ryzen AI 400 series. The integrated NPU is a key differentiator there.
And then there's the embedded business, which often gets overlooked, but is high margin and based on that huge Xilinx acquisition. That segment must be acting as the R&D fuel tank for this whole data center pivot, right?
Absolutely. The embedded segment is the stabilizer and the high-margin fuel. This segment targets a path to over 70% market share in the adaptive computing market. And this is driven by incredibly strong, long-duration design win momentum.
How strong?
They have over $36 billion in total secured wins across various high-reliability sectors.
$36 billion in secured wins, that's significant. What's driving that high-margin business specifically?
It's highly customized silicon that carries substantial IP value. For instance, they have $15 billion in secured wins in semi-custom silicon for areas like automotive, aerospace, defense, specialized 5G infrastructure. These aren't general-purpose chips. They are optimized, high-performance, programmable silicon solutions, FPGAs, that carry very high gross margins, often well above the corporate average.
And that predictable high-margin revenue provides the financial bandwidth to fund the high-risk R&D needed for the GPU and CPU roadmaps.
That's exactly right. Gives them the stability to challenge the data center incumbent.
Okay, let's bring this conversation full circle. We've established that the AI build-out is the greatest infrastructure construction project in human history. To summarize AMD's comprehensive offering and their open strategy, let's use that construction site analogy we talked about.
Perfect. So if the dominant competitor, with its proprietary, highly integrated platform, provides the single source for proprietary heavy machinery, a closed, specialized fleet where every part comes from one vendor.
Then AMD is offering the essential alternative.
An open fleet of best-in-class, specialized components, all designed for seamless interoperability and superior TCO.
Okay, let's define the fleet. First, you need the raw computational power, the heavy lifting for training.
That's the heavy lifting and the accelerators. The Instinct GPUs, specifically the MI450 series, they provide the raw training and inference compute, often with superior memory capacity, which is crucial for running bigger frontier models efficiently.
Next, you need the site managers, the coordinators, the architects for the whole project.
That role is taken by the project managers and orchestration. These are the EPYC CPUs, including the next-gen Venice processors. They are the essential general-purpose compute workhorses driving agentic AI, managing all the ROC and ETL workloads, and just ensuring the massive GPU fleet is efficiently utilized.
And finally, you need the infrastructure, the high-speed roads and connectivity to move all the material around the site without creating traffic jams.
This is handled by Pensando Networking and their unwavering commitment to open industry standards like Ultra Ethernet. This ensures seamless, high-speed scale-out for the entire cluster and guarantees customers the flexibility they demand at Yotta Scale. It's a full-stack offering built on an anti-proprietary foundation.
And this whole structure seems designed specifically to repeat their past success. The ambition is clearly defined as achieving a Milan Moment for GPUs in 2026. For those who followed AMD's history, the Milan generation of CPUs was when they decisively broke the incumbents' hold on the server market.
That is the core narrative of the bull case. The strategy is to leverage the technological strength of the MI450, its memory advantages, its strong inference performance, and combine that with deep customer partnerships, like the one with OpenAI, to build that necessary trust. In 2026, the confluence of the MI450 launch, the Helios platform, and those multi-gigawatt deployments gives them a momentum to make a decisive leap toward double-digit market share in the AI accelerator space.
The market is screaming for a viable, open-source TCO alternative.
And AMD is positioned to deliver it.
But every investment comes with risk. We have to conclude by addressing the huge bet that's implied in the current market valuation. If everything goes right, maybe that $20 EPS target is achievable, but the market is already pricing that expectation in. AMD is trading at an extremely premium valuation, roughly 90x forward earnings. That's about twice the multiple of their dominant competitor.
That 90x forward earnings multiple is a heavy lift. It is a huge bet on flawless execution and rapid market share gains across every single segment at the same time, not just the data center. To justify that valuation, they have to deliver a sustained EPS CAGR of over 43% for the next 5 years. There is simply no room for error.
And that premium valuation leads directly to the core bear case argument. What if this fervent pace of AI infrastructure build-out is just unsustainable?
That's the big fear. The bear case argues that the entire AI spending spree, fueled by massive CapEx from hyperscalers, might be creating an infrastructure bubble. They compare it to the dot-com bust of the early 2000s. Critics are citing estimates that companies need to generate $2 trillion in new AI revenue by 2030 to profitably justify the CapEx involved.
And the trends don't support that right now.
Current revenue trends suggest a potential $800 billion shortfall against that target. If the monetization doesn't arrive as quickly as the infrastructure is being built, the spending will slow dramatically.
And if that infrastructure spending slows, the vulnerability of customer concentration becomes acute, especially since so much of AMD's near-term growth relies on just a handful of these huge customers.
Exactly. The collapse, or even a major setback, of a key customer like OpenAI could trigger a swift reckoning for the entire market. If that foundational demand drops off, or if one of the major customers decides they just can't monetize their AI infrastructure fast enough, it could prove the current premium valuation unjustified and lead to a sharp pullback in capital deployment across the whole sector.
The risk is high.
But the potential reward achieving that Milan Moment in GPUs is equally transformative.
So we've completed our deep dive into AMD's Yotta Scale transformation. It's clear this is not a chip launch. It's a coordinated full-stack strategy. It encompasses hardware, software, and systems, all designed explicitly to disrupt the data center market.
Their relentless focus remains locked on delivering the best total cost of ownership to the largest hyperscalers who are desperate for alternative, optimized, and flexible solutions that can break that proprietary lock-in. The foundational technology and the strategic relationships are clearly in place.
So what does this all mean for you, the learner? AMD's history has consistently shown that they thrive when incumbents become complacent and when the market demands a viable alternative focused on TCO. And crucially, you heard that their engineering teams are actively accelerating development with AI tools to build the open ROCm stack faster.
That detail is the key differentiator. Today, the competitive battle isn't about raw silicon speed, it's about the software ecosystem. The hardware is competitive, but that proprietary software moat is still the primary barrier.
Therefore, the final question for you to consider is this. If AMD's ability to gain meaningful double-digit market share relies on winning a software battle to close the functionality gap with proprietary systems, how quickly will the adoption of AI-driven code acceleration using AI to help write, optimize, and debug the ROCm code faster allow the open ROCm stack to finally catch up to the proprietary leaders, thus making TCO the only variable that truly matters to those multi-gigawatt customers